Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Join me at the market site in Times Square. We have Chris Dearborn. He's the Managing Director on Nasdaq's Market Intelligence Desk. And we're here for the midday update. It's a Friday. This is my favorite hit of the week when you're on with me because I know we are just at the finish line. And before we take a look at our charts today, kind of what's going on. We just went negative on the S&P despite opening up in the green.
Well, the markets are really in a holding pattern here. You had the move, that was Wednesday. The markets rallied significantly. We held on to that for the most part yesterday, and today is kind of a proliferation of that. It's a big, long word. What you're looking at really is a holding pattern. The markets are still good. The S&P 500 made a new all-time high intraday. We haven't closed above it yet, but we're still right there. The Dow is within a half a percentage point. The Nasdaq Composite's about 1.5% from the all-time high. What you're looking at here is money being put to work. It's really kind of, things aren't so bad, but they are. And the macro is really driving this. There's nothing really that has changed. The macro global economic story is still kind of negative. Look at some of the PMI data that we got today. It goes hand in hand with the Philly Fed earlier. It goes hand in hand with the expectations of a rate cut, which is now stands at 100% for July. Some people are calling not just for a quarter of a point cut, but there's a camp of about 25% of the economists that are polled by Bloomberg that says they could cut it by a half a point at July. So what you're looking at here is really a good as bad scenario to propel not only equities, but also bonds higher. And that's part we'll talk about in a minute, but the yield on the 10-year is now below, tick below 2% yesterday. So money's being put to work. I mean, you got negative rates on the German Bund right now. People are putting money to work to a point. I mean, you have some people talking about Lipper fund flows and one of the highest inflow weeks of the year. I don't know.
So that's where my concern is.
I don't know.
And we spoke about this earlier in the week that there's such a high expectation of these rate cuts in July. So the reaction after that is what I'm curious to see. What happens with forthcoming data over the next few months, over the next quarter? If data is really good, do we just waste two cuts? If it's bad, do we have any more tools in the treasure chest? So I think it just keeps layering to this uncertainty that's out there, which is why, making intraday all-time highs, I don't know. And you're seeing a little bit more of a defensive posture today. Let's take a look at the first chart, though. So we have something to look at here.
You get the daily and the S&P 500. Again, one of my favorite charts. We bring it up a lot of times when we speak. And it really is just showing you what the patterns are. You can see over in the far corner over there that we're making higher highs, and you're trading north of the 2950 mark. Again, you got the three moving averages on here, 50, 100, and 200-day. Some people like to use them. Some people don't. I do. The 50-day is near term. That's the purple line across the board. That shows a near-term trend in the index broadly based. The green line is the 100-day moving average. Again, that intermediate day, it's a 100-day rolling average on where it is at the moment. And the 200-day is for those longer-term investors of where the index is sold. With the index trading significantly above all three of those averages, look for support on every one of those levels. Even if we do get a pullback on some type of macro factor, and we are, again, one macro factor away. Next week, we've got the G20. Something goes wrong from expectations here, you will get a significant pullback. Again, this market move has been driven by macro and macro alone. And the economic data, while still showing growth here in the U.S. on a global scale, is not so good. And Mario Draghi kind of put that into plain words earlier in the week, which also sparked part of this rally. Again, bad is good, but fear is still there.
But this is what concerns me, that the market is moving on macro headlines. But from a fundamental perspective, and we're going to get this a little bit more as the earnings season picks back up in July, it seems like every corporate management team that you hear from, they just don't know what the next quarter or two is going to look like because global trade policy is so uncertain. And that's where true growth comes from, is from the fundamental side, not from tweets or trade wars or stuff happening in Iran.
Macro drives the market, always has, always will. Macro will dictate what the equities are going to be doing underneath them, whether by sector or stock, because you cannot drive a global economy without a stable macro environment. And without that top part of the puzzle, the corporates who drive to the bottom line are unsure of what's going to happen next. And that is going to continue to drive stocks one way or the other.
All right, let's take a look at that 10-year.
Or
is it spot 97, I think it was?
Yeah, it was the low. So my colleague Brian Joyce did a great job on the write-up today for our daily blog about this. And what you're looking at here is the 2% level is kind of a mental block for people. People like round numbers. That's why you see stocks. People put orders in for half dollar, 25-cent, dollar range. The same with the yield. Remember, yield goes inversely to the price of the bond. The more people buy bonds, that drives the yield down, right? So what you're looking at is people are buying stocks. We're making all-time highs. People are buying bonds because they're putting money to work, but they don't know where to put it. So what you're looking at here is a continuous decline on the U.S. 10-year yield, and you're trading at 2%. We're just above 2% today. What it's looking at is an exhaustion move. People are looking at this and saying, you know, we think that it is overbought, thus the yield is oversold, and we're thinking we're coming to a bottom here on this. And if you look at the support that you've seen over the last few years on a weekly basis, it has proven to be just that. Brian goes into some of the technicals about a hammer pattern here, and we agree significantly on that it is a sign that you could see a significant bump up on the yield, which means people will start to roll off of bonds and put that money back into equities because there'll be some certainty to what's going on the macro picture, which goes to the overall theme.
All right, let's wrap it up here. We have about a minute to go. Big volume event on the close.
Right.
Lots going on.
Absolutely. So it's quad witch, and concurrent with the quad witch, we have the S&P family of indexes rebalanced tonight at the close. Generally one of the highest volume days of the quarter, and some of them could be the highest volume days of the year. So the S&P and the quad witch occur the third Friday of every quarter on the third month. And you have the concurrent expiration of options and futures for both stocks and indexes. Adds volume to the opening. That's why the opening crosses were big. Adds a lot of volume to the close when the S&P families rebalance. Think of it as a net asset value or NAV for the indexes. A lot of passive money has to be involved with that last trade to keep the indexes whole to the investment thesis of the S&P that they're in. Whether it's the 500, the 400 mid cap, or the 600 small cap, or any part of the drill downs from there, whether it's growth, value, or the super composite. What that's going to do is drive volumes up. Generally speaking, volume is about 50% higher on a quad witch day when you have the S&P and that happening. However, last year, during December, when we had the significant sell-off, volume was over 100% for that day. So we're not close to that volume right now. Markets are kind of stable at the moment. There's no massive sell-off. We're trending a little bit lower, so maybe we'll get that 50% number today. We'll see what happens at the end of the day. And then, of course, next week, we're at the big high volume day of the Russell, which is generally one of the 5 highest volume days of the year.
All right, good stuff. Thank you as always, Chris. And thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.